Okay, we're live. Yep, go ahead.
Okay, good. All right, I'm just gonna give it 1 minute until we tick over here until 5 o'clock, and then we're gonna get going. All right, well, it's 5 o'clock here, so I think I'm gonna get started, get ourselves moving. Got lots of things to cover. Obviously, I'm always excited to do these. Give me an opportunity to look back at what the past year transpired. We had a lot happen in 2020, so got lots of things to cover today. I wanted to first off, though, say thank you all. I appreciate all the continued trust that you're placing in me. I take that very seriously, and we're excited about what's happening. I'm looking forward to 2021, the new firm. I think there's lots of opportunities for clients, and I'm excited about that and getting it started. So it's amazing what year difference a year makes. From 12 months ago, I went back and obviously looked at my last presentation in 2020, started 2020. I also look back at 19, 18, 17, have a look at some of those things that I commented on then. But primarily I wanted to go back and look at what happened in 2019. We 2020 was a year of pandemic, lockdown, new president, market volatility, and so there was a lot of things that happened in 2020. Coming into the start of last year, we had the complete opposite of that happen in 2019. We had one of the lowest volatility years of all time in 2019. And coming in the start of this year, I talked about the fact that I was a bit concerned about what could transpire in 2020. One of the quotes that I'd posted up said, "Stability breeds instability." That was not more prominent than last year. We'd gone through that period of crazy stability, and then you had a massive blowout in volatility and explosion in volatility, which we'll talk about as we get going. So we had that material sell-off, and then ultimately what happened is somebody saved the day again. And for everyone following along, again, it was the central bankers of the world coming riding to the rescue to figure out how we can save, we'll call it, the markets. So excited to get going, lots to cover, but the first section we got to touch on and read out before we go through. Disclaimers, very important. I wouldn't be able to do any of this if we didn't have that. This is not intended to be investment advice. You should always speak with a licensed advisor before proceeding on an investment strategy. Everyone has their own risk tolerance, and you should adhere to that. This broadcast is for information purposes only and are the opinions of the Hard Investment Group. So excellent. Thank you very much. As we move through today, you may see a few drinks from the coffee cup. As I've been sitting home at lockdown, also been trying to drink a lot more water. So I don't know if you guys have seen these. There's a little time for how much water you should be drinking throughout the day. So I may have a few sips on that as we run through. So let's get going. I'm a big fan of the quotes and thinking about some of the famous investors. And as we look at this one, it's the key to successful investing is having everyone agree with you later. So this is a famous investor, Jim Grant, talking about investing and talking about some of the challenges with investing. And as I think about being a portfolio manager advisor for you and trying to find the most success for getting you to your goals, I think about this a lot. And so this industry was typically built on kind of backwards looking. Let's look at what happened last year and try to chase what happened last year. I've spent so much time trying to see what's ahead, trying to put you in a position to succeed as we look forward. And so we've had some challenging times over the years where I've bought positions where it doesn't work on day one. Lots of people want to see everything happen the day you put this in place. And 2020 was really an example of some of the seeds that I'd planted over the past couple of years really came to grow and really put the portfolios in a position to do quite well. So 2 years ago, Had started putting gold and gold miners into the portfolio, and that didn't work right away. It actually took some time for that to play out, that thesis to play out, and then over the last, we'll call it 6 to 18 months, that did very well. It was a huge contributor to success and portfolio success in 2020. Additionally, the other one, which we've talked about for those who have been listening to the weekly calls, whoever joined my quarterly calls over the past 12 months, you'd also heard me talk about crypto and Bitcoin. So Bitcoin was something where I'd spent a lot of time trying to study and understand it. And ultimately, when I decided to put it into portfolios in May of last year, there was a lot of pushback. There was a lot of pushback from clients and from my syndication department, from the firm that I worked with, just thinking that this wasn't a good decision. So that's one that turned out quite well. Obviously, it was up about 300% for where I bought it for clients. So that again is something that works well. But ultimately, I'm always trying to think about, what are these things that we can put in place and plants now that are going to provide good long-term success for you. So this was another one, and listen, this is Davos time of year. So if you're interested in politics and finance and kind of the world view, you always have some interesting stuff that comes out of that. And this time last year, we had Bob Prince, who's the co-CIO of Bridgewater. Just a reminder, Bridgewater is the largest hedge fund manager in the world. So Bob and Ray Dalio are partners at Bridgewater. They manage $170 billion, but I'd looked back at kind of some historical events where other people in history had said, well, we've reached a permanent plateau. And so Bob said this last year, and at the time I said, I think it's pretty likely he's going to eat his words at some point in the not too distant future. So he said the lessons that we've learned from that, which he'd say, past cycles. Someone was asking him about the depression, and he said, I think it really was a marker that we've probably seen the end of the boom bust cycle. Not too long after, maybe a couple of weeks after he said this, is when the market started to sell off. So, it's important to remember what's happened in the past. It's not the only thing that we think about, but it's important to think that about what has happened, what's transpired, and making sure we're thinking about what's coming at us as well. You can't make decisions in a rearview mirror. So my thesis and my view hasn't changed. I really do think that overconfidence is the root of all losses. So if you end up getting stuck and sitting in one position because you think you're so smart, that's typically when things go the other way for you. So even if I put something good and solid in place, whether it's gold or Bitcoin or individual stocks or long bonds, you can't get so locked into that position to think that's going to work forever. You got to make a realistic expectation. If you got bonds in the portfolio and the weighting gets too much because you made a nice capital gain on it, typically, like we saw start of the year here, we saw long bonds rally 25%. That's not a normal return profile for long bonds. So you have to think about that, trim it back, reallocate the money elsewhere. Similar with Bitcoin or gold, even if the position gets big, you got to trim that back and put it into something else, and constantly thinking about where those places are to reallocate, and not getting overconfident, because when you get overconfident, you get over your skis and you make bad choices. Bad opinions can be very costly. This is something that I see and think about on a continual basis. Oftentimes you get these sound bites, right? I get questions from clients and people I know. They say they're talking to their brother Jimmy about this trade, or they're talking to their neighbor about this trade that worked for them. I think that what happens is you kind of get locked into that opinions about, you think that that's the only thing to do, or this one trade out of the thousands of trades that you've made are going to save the day. So, you got to take opinions with a grain of salt and think about who it's coming from and what it means to you and your portfolios. And that's what I think about from a view of managing money. The other one is that consensus is often wrong. So I really think that being an independent thinker is of the utmost importance for investment success. So when I'm taking inputs, I'm taking them from multiple different sources, paying for different research feeds, whether it's macro or stocks or economy or politics. Then you got to take them from different places, and you got to take them from a source that you believe that their core focus is on doing a certain thing. If you want macro research, well, you want someone that's focused on macro. They're not paid to do investment banking advice, or they're not paid to bring money in from one sector or another. They're paid on focusing on one thing. And so I think you have to take different views, different viewpoints, and boil it all down to what is a solid investment thesis to run money in the portfolios. The last one here was about being patient and not stretching for short-term returns. And so this does require a significant amount of discipline, and it makes you in a strong position when things work or don't work for you. So, I think being patient and not stretching for an extra 1% return when your downside's 50, that's not a logical decision. But sometimes we're driven by the fact that we want performance at all costs, and that's not how I think about things. You don't want to stretch for 1% if you got 50% downside. Yes, you're looking for a better setup where, if the downside's 10% and the upside return's 50, that's kind of the risk return you want when you're allocating to something from a risk perspective. So I think being patient and not stretching for returns is very important. So maximizing portfolio returns, I think about this often. I think about making sure that putting you in a position to succeed. So I want to make sure that the portfolios are growing, that you're working towards the goals that we've set out for you. We will also additionally want to have stability. So I've had lots of conversations about returns, but I don't often get the question about what was the return profile in my portfolio. So that's not a typical question that I'm going to get from people, is what was my return profile? Well, a lot of people don't care about that, but you kind of put two things together and you say, okay, if my balance return was 8%, hypothetically, and last year the TSX return was about 2%. Well, when you think about those two things, they look like a pretty similar risk return profile, but the TSX obviously had a 37% drawdown in March, where if you manage money effectively, which I think I did last year, your drawdown was a much lower number, something around 5 to 8% drawdown. So, most people, if you ask them, they're going to want that same balanced return profile where it's nice and stable and steady. But oftentimes we get so focused on that return and not thinking about how we got to that return. So safety is something that I spend a lot of time thinking about too when I'm balancing portfolios. What's the safe place? What's the thing that I have in portfolios that give me some certainty? If something happens, I have cash there, either to meet some income needs for you, or either to meet you have an obligation, something, family, kids need money. So I think about that safety piece when constructing the portfolio. And the last one is risk management. I mean, risk management was no more important than we've ever seen it this year. And as we've talked last year, I'd put some things in place where I was owning some puts in portfolios. And just a little slight comment on that. I'm always thinking about how I can effectively risk manage the portfolios. And so we owned S&P puts coming into the significant market sell-off. We had some puts that I'd bought on Valentine's Day last year, paid 25 cents for those puts. And as we got into the later February, early March, those puts went to $4. We realized some profits. We did that again for another couple of weeks. And then ultimately, I did put some more back on in the summer. They expired worthless at the end of the year, but this added a couple percent of return protection within portfolios over the past year. So 2020 really was a year split into, I'd say, three kind of prongs. And so I split it off into, I look at it and I know it's a bit of a kind of a corny phase, but I really think we had panic. We had a panic moment. We had some manic buying, and then we've had manias. And so manias started last year, but I really think that we're still in the mania phase. And so I'm going to touch on that as we go through. But the panic phase was the first one, which we saw in February, March, where we had panic. We had indiscriminate selling across the board, across all asset classes, stocks, bonds, equities, high yield, private debt, real estate, mortgages, exchanges, everything kind of, everyone was panicking, hitting the sell button. So we'll go through some of that. And then the other side of that, we had manic buying, everyone afraid to miss the next upswing. And so you had this kind of manic, that first manic breakout phase out of, we'll call it March, April. And then as we get into this last back half of the year, we're starting to see some serious manias. So we'll touch on that, and I'll touch on kind of how I've seen that play out. So I just, I know we all get so stuck in kind of the where we are today and kind of the thinking around the shorter term. And so I took obviously lots of pictures throughout the year, the good days, the bad days. This is one of them I just wanted to pull up as a reminder here. This was about 12 months ago. We had multiple 1,000-point days down on the Dow and the TSX. I didn't put the 2,000-point down day on the Dow up. Just a reminder that this is a snapshot of one of my quote screens. It's just a reminder of the volatility that can happen in markets quite quickly. And so it's something that I think about when I'm thinking about what's happened last year. So just the mania, I'm sure if you're pulling up BNN or CNBC, or in fact on any headline from a financial media right now, it's all about, there's all this talk about what's happening on Reddit. So Reddit, for people that don't know what that is, it's a forum that people can communicate with each other. They're still a private company. They're actually probably going to go public very shortly. And I think they're going to get a lot of press off of this. But what we've had in this kind of Reddit forum is you've had, we'll call it the Main Street investors. So the individuals that are investing in equity markets start to have some power over what's happening in stock prices. So we've seen a big resurgence of the retail investor. And so up until the last, we'll say 6 months, retail made up, a small percentage of the trading, maybe 4 or 5% of the daily trading on most of the markets in the world. And so we've seen that dramatically increase. Something around 30% of daily flows come from, the discounts, like the Interactive Brokers, the Robinhood, the TD Ameritrade, TD Waterhouse in Canada. We've seen an explosion in kind of retail buying. And so if you look back at some of the things I'd put out last year, you've seen a lot of people. There was lots of questionnaires going out about what have you done with your either CERB money, or in the US, what you've done with your unemployment money. And across all income brackets, so one of the top 5 things that people have done is they've invested in the stock market. And up until recently, it wasn't individual stocks. And you could see that over the last 6-9 months, where you've seen retail buying in the hardest hit, lowest valued stocks. And now what we've seen massive buying happen is in calls. So we've seen call option volume go off the charts. We've had many days where you've had more calls trade than the underlying stock, which is something we've never seen in history. But the one that I wanted to bring and point out is just the mania we're seeing around this particular one, which is GameStop. So GameStop traded around $6 a couple of weeks ago. It followed it on and off, and have owned it on and off over the years. But if we look what happened over the last couple of weeks, is we've had this group within this Reddit forum decide that they were going to go after this hedge fund manager that was short GameStop. So his view was that GameStop was going down, likely probably going bankrupt, had a massive position on it. And these people in this Reddit forum decided they were going to go after this particular hedge fund. And so what they did is they started buying it. And so, there's a kind of a natural thinking that it was them that did it. And so some of it was, there's about 2.4 million people in this forum. But the one thing that most of these people do is they buy through Robinhood. And so Robinhood is a discount trading firm in the US. I don't want to spend too much more time on this because I know I'm getting in the weeds on it a little bit, but they end up selling their trade flow data to Citadel and the big hedge fund managers of the world. So you have this whole retail stream piling into a trade. You get the other hedge funds, Citadel and the like, front running those trades. And we saw a massive explosion, which I think was the blow off top today. We saw GameStop go under $482, come down hard to 112, and kind of finish the day around 250. And so, it's been interesting to see what's happened. You had that hedge fund manager yesterday crying on CNBC. You had the banks come to the rescue and say, retail investors, you're not allowed to trade or sell these stocks anymore, or short them, or buy calls. And you've had kind of the banks and the central planners riding to the rescue of the hedge fund manager. So it really is a mania phase and something to pay attention to. I know I've talked about the fourth turning a number of times, and these are fourth turning like events. So something to pay attention to. Last thing before we dive into a little bit more of the meat of it, I'm sure you're all aware, we've seen these statistics. I just want to say, listen, it's we're all going through an interesting, challenging time. There's a lot of mental health issues. We try to talk to you as frequently as we can. Want to make sure you know that we care for you and we're there for you. And if there's anything you want to talk about from a portfolio perspective or just to check in, certainly please give us a call. So as we go, I'm going to take you through what worked in 2020, what I think works as we go ahead. Obviously, I like to get into my charts, and I know some of the clients have mentioned in the past, maybe there's too much data, too much charts. It's something that I think it tells a story, and sometimes we need to look at it that way to think about that story. So we'll take you through some of that. Crypto, which is Scott's favorite subject, we're going to hit on that, of course. How my views have changed. Continue to talk a little bit about the core strategy and digital connections. So what I forgot to mention on the outset, if you do have questions, Scott's monitoring it. So if you want to enter your questions just in the chat box down there, over there on the right-hand side. So certainly, please feel free to do that at any point. The other piece I wanted to mention is that we do, as the feed comes out, there is about a 20-second delay. So if you are asking some questions, it may take me a little bit of time before I come back to that. So don't be alarmed. It is taking a little bit of time as we go through. Just a function feature that allows the stream to happen from this perspective. So the big events of the year, obviously there's a number of them, but COVID-19, coronavirus, call it whatever you want. I mean, I think that was a big material impact and is the material impact for what happened last year. And we saw massive intervention everywhere in the world. So coronavirus and COVID was a big part of that. We've gone into lockdowns, which is something that I never anticipated seeing in my lifetime. So that's had a big impact on financial markets, on really the real economy, and I think going to have long-term ramifications for how work comes back. And so that's important to pay attention to. U.S. elections. I think the world voted, whether you like Biden or you like Trump. I think the one thing that has really come to the fore is that you've seen massive interest in it again. And so I think it's a very important feature of democracies, is you really want people to come out and vote. And so they had more votes than they've had in 100 years in the United States. So that's a real positive thing. And I think the next president is going to be somebody of a different ilk, I believe. And I think somebody that really has the potential to create massive change. But Biden, we got a lot of certainty. We got Yellen, Powell. We know a lot of these key actors, and they're going to have a big impact on what happens to things as we drive along. The uprising is another thing to pay attention to. I know there's been a lot of because we live in Canada, we see what happens in the United States. So there's a lot of focus on the riots on Capitol Hill. We saw lots of rioting around when Floyd was killed. There's a lot of things that have happened in the past 12 months that really make you start to pay attention to what's going on. And so really the meat of it, what worked for you, what worked in your portfolios, and we're gonna hit on those. I think it was a great year from a setup perspective. My base case, as I said 12 months ago, is I expected a mild recession as a result of expecting a mild recession based on what the macro data was saying, is we had portfolios positioned for what happened and how the sell-off came. So I think these are the things that I took out of my presentation from last year. It's still on the net. If you Google it, you can find some of the predictions, some of the things I talked about there. But I thought that gold and gold stocks could perform quite well, and they were a big winner up until about August. They certainly still had a great year. They outperformed equity markets significantly, and I did make some tactical changes in August, September to reduce exposure there. The other one was government bonds. Obviously, this was front end heavy loaded. So government bonds in both Canada and the US outperformed equity markets last year. Front loaded, of course. Most of that performance came in the first 6 months of the year. But government bonds outperformed equities again. And so generally would probably wouldn't hear this in the media, but that's certainly the case. So, and then Bitcoin, Bitcoin, oftentimes people don't want to talk about it, but Bitcoin's something that I think is and has been one of the best performing asset classes on a 1, 2, 5, and 10-year basis. There's quite a bit of volatility to it, so you have to think about from a percentage perspective what's appropriate within the portfolios. So Bitcoin was a top performer. Certainly something that we can talk about and evolve. It's something that most advisors didn't put in clients' portfolios, and I'd say most, that's probably 99%. So I think that this has been a really nice, solid contributor to your portfolios, and it's just really focused on me thinking about what's coming ahead. So index puts, as I mentioned, good risk contributor to portfolios last year. Alternative assets, which I think I highlighted last year, I know I highlighted last year, which at the time was called the Vertex Merger Arbitrage Fund. Now it was acquired by Picton. So Picton's a big alternative asset manager. Excellent fund. They did very well last year. Double-digit returns with a 3 standard deviation, which is about bond-like volatility. So excellent, and continue to be something that I think is important within portfolios. And so what didn't work? Emerging markets struggled. So yeah, I think this is as I look at the portfolio from different time frames, this is a tail perspective, something that I think has the ability to outperform long term. And I think about emerging markets, I think on a long-term basis, they should do quite well. My view is over the next 3 to 8 years that I think you get emerging markets outperforming the developed world markets. So, as I've started to talk about these different things, I think emerging market still has potential. We'll talk about that on my future views. And the U.S. dollar. So I certainly thought that the U.S. dollar would have a better year than it did. This is probably the single biggest short position out there in the world today. So I own U.S. dollars across client portfolios. So from a contrarian perspective, as a portion of the portfolio, I think owning US dollars right now is an important asset class. We're starting to see that dollar base a bit, and the dollar plays a major part in what happens next. But it wasn't a positive contributor to portfolios last year. So those two were the big things. And so, as I spend so much of my time thinking about what I can do, how I can make things better, while the good things work and the great, and I'm happy, and that's the objective, I constantly hard on myself about finding what I can do better and what we can do better for you and your portfolios and helping you get to your goals. And so as I've looked and did some analysis in the portfolios, which I spend quite a bit of time on, so I think about what worked and what different. Obviously, we had a lot of things that did well. From a sizing perspective, there's some of the things that I could do. Instead of a 2% position, maybe it makes sense to have a 3 or 4% position, and trying to look at those things, because the holdings that we did have did exceptionally well. That's why the performance numbers were good, but maybe we can increase the size. So I'm thinking about that. The other thing that, because I built my views when I came into this business, as many of you know, I first bought my first stock when I was 13. I came from that kind of valuations perspective. I wanted to think about, what's the intrinsic value of it? Can I buy it at this price and then sell it at this price? And it's something that worked for a long time. Obviously, it's made Buffett very successful and some other value investors, but the world has changed significantly. And so, I think you have to adapt to what's happening in the markets in the world. You don't throw away everything you know about valuations, but you do also think about how things have changed, where the money's coming from, who's controlling the markets. And so you got to think much more about the flow. And so I've spent a lot more time trying to understand where the flows are coming from, who's putting money into the system, why that money's coming into the system. And that's been a learn in the last a couple of years. And so additionally is to study the daily data. So, I don't want to get in too much on the weeds on this one, but you got to study the implied volatility of things, realized vol, cycle signals, and then seeing how that has an impact within portfolios. The other one is when you've spent the time, you've put things in place, and then you get a signal come in and it kind of maybe doesn't agree with your longer term goal, but the signal to buy short term's there. You have to take that signal. And so what I found is that I've been doing that over the last 6-9 months, and it's been real positive contributor to the portfolio. And it's really been trying to have a multiple view of where we are. So I'd break it out of what's happening over the next, we'll call it 6 to 12 months, and then what's happening over the next 12 months to 3 years. And so when I'm constructing that portfolio, it's a little bit of a combination of having those two pieces and continually repositioning and making sure that that portfolio is having nice, stable return profile. So one slide on Davos as this is always that time of year that I start to think about it, is we get the three kind of controlling powers in the world, which is the politicians, central bankers, and corporate leaders. And so the theme of their event this year was the Great Reset. And so I spent time thinking about this. We talk about the fourth turning, this kind of this long cycle event that we're in. And I think about these leaders talking about the Great Reset. And so I listened to a lot of them. And the people I were most impressed from was some of the corporate leaders. And so I listened to the CEO of PayPal kind of talking about this world that we're in, where you get a massive separation from the haves and the have-nots, and some of the things that he's put in place to help his employees. And so he did a survey a couple of years ago talking about trying to find out how many of his employees live paycheck to paycheck. And what he found out, it was a massive number, somewhere north of 90%. And so he got, obviously that was concerning for him, and he started to think about what are the impacts of that. What is this going to do to my organization? Are these the kind of people that are going to help and get us to the point where we can continue to grow? And so he put some systems and programs in place to really put the company in a better position, and that number has dropped significantly from north of 90 now down to about 80. And so he really thinking about what that means and how they can think about what people want and what they're looking for. And so some really great corporate leaders, the central bankers and the politicians, they're really still thinking in a backwards looking way. And so I think we got a long way to go before we get to that point where they start thinking about working together. And so just some of my comments earlier, I talked a little bit about the kind of leadership in the world, particularly on the political side. And if you've read The Fourth Turning, it kind of talks about the different types of people that are in the world. And so this makes me think a little bit about what's happening right now. You've seen some up and coming politicians in Canada and the US, and you've seen some kind of drastic conversations around what could happen and what could be. I think as this progresses, and you've studied kind of politics and the leaders of the world and these different demographics, I think probably coming into the next cycle when we get a new president next time in the US, you're probably going to get somebody that's either we'll call it a Gen Y or a Zillennial, depending on how you look at that. The Gen X, my generation, has historically stayed away from the political front, and it's not something they want to get engaged with. And it's just a result of our time and when we grew up and things like that. But I think if you get kind of that younger thinking generation, like some of these corporate leaders of the world, I think we're probably some different potential outcomes. But this is tail stuff, longer term things to think about. Nothing immediate there on the horizon. So I'd say as we talk into crypto, I can definitely get into this and talk about this all day, but it's something that I think really has and is going to play a material part in the finance industry. And so crypto sits on this real unique blockchain technology. And so this blockchain technology is thinking about how it can integrate into the finance system of the world. And so my journey started with it in 2018, as I think most people started to follow it around there. Obviously, lots of people started before there, but from my perspective, it kind of gained notoriety. It's kind of that tulip mania type thinking where you only had long side buying because there's no options, derivatives, no futures on it, driving it up to that kind of $20,000 a coin level up into 2018. Then the Chicago Board of Exchange allowed futures to be traded against it. So this is the first time someone had the ability to short the currency or short Bitcoin. Some people call it currency, short the Bitcoin. And so at the time when people were asking me, I said, listen, I think it could probably drop 80%, 90% from there. And that's about what it did. And now we've come out the other side of this, and you've seen it gain additional traction. You've seen a lot of more focus on this being an asset class. We saw Ray Dalio today come out, raise the largest hedge fund manager in the world, managed 170 plus $billion, which is tenfold bigger than most funds. And he put out a paper on Bitcoin, talking about it, where it fits, what he thinks about it. He claims himself not to be an expert on it. I mean, he's probably one of the brightest minds inside finance talking about it. And so this is coming out everywhere. So there's a lot of things to think about it today. For anyone who's followed kind of that S curve thinking, I think we've come out of the bottom of that curve. We're starting to make our way up to the midpoint of this S, and so I think it still has the significant potential to grow from there. And I say crypto instead of Bitcoin because there's a lot of different currencies within it. Bitcoin's 80% of that whole category, and so I think about it, and I think it has significant potential within people's portfolios. So why does this matter too? So I think why it matters is that you've seen a big change towards like technology, and you've seen places want to think about how do we preserve our capital? How do we make sure we retain our purchasing power? Yeah, I put up in one of my dailies there probably a month ago or so, talking about how much money was put into circulation in the past 12 months, and that U.S. number is somewhere around 30 to 40% of all money created ever in the United States was created last year. And so you get asset managers and Ray and Paul Tudor Jones and many others talking about this and saying, how do we protect our purchasing power? And so this is why crypto's gained this interest. If you got this massive debt load, which typically devalues currency, and so they're starting to think about how do we protect our purchasing power. So the other one I wanted to hit on, just talking about a little bit, is because we see Christine Lagarde talking about how she thinks it's bad, that crypto's bad. We had Janet Yellen last week come out and say the same thing. But then on the other hand, we had BlackRock saying we're going to see how we set up an ETF or a fund that allows it to purchase that. And so, I think if BlackRock saying that, they're the largest asset manager in the world, they got a lot of sway. And I think ultimately this is something that's happening now. We have ETF filings all over, so exchange traded funds. Ontario is probably going to be the first to do it. Horizons and another firm filed to issue one. So sometimes there's this misconception that that central bank digital currency and cryptocurrency can't coexist. And so when Yellen and Lagarde speak about it, there's sometimes a confusion. So I wanted to hit a little bit about this. So this is CBDC, which is central bank digital currency. Well, most currency these days is digital currency. However, one of the challenges that central banks have had is they've had a big challenge with trying to generate inflation, trying to stoke inflation. And so if we look at this, we get these conversations around like the M2, M1, M2 money. And listen, this is a concept. I'm just going to keep it simple. But what happens is we've had this massive amount of money coming into the system. It's called M1. That's been created in the United States by the Fed. So they're creating this money. So we've had that go up big. And so what's happened is all of that money has gone into the banks. So in JP Morgan, Wells Fargo, they've gone into the banks. So we've had a massive amount of money going to the bank. So you've had a flood of liquidity into the system. And this has a material impact on what's happened to asset prices. So you've had that flow into the system, which gets lent out to hedge funds and institutional investors, so on and so forth. which actually never comes out because it's just being borrowed. And then we have this M2, which is the velocity of money. So this is how much of this money is going into the real economy. And so you got a huge kind of alligator where you got big amount of M1 or M2, small amount of M1. So what the central bankers have started to talk about, you can read this on IMF, you can read it on multiple places, talking about how do we force money into the system. And so, Ben Bernanke's talked about this helicopter money before, but really what they're talking about is they want to digitally put money into your system. They'll say, Scott, we're going to give you $5,000 in your bank account today, but you only got 90 days to spend it. If you don't spend it in 90 days, we're going to pull it back out of your system, out of your bank account. The one thing that they know for certain is going to happen there is you're going to get a massive amount of inflation. So as we think about it, this is something I just want to bring to the attention, just starting to think about these multiple things. We talked about Bitcoin, and we'll cover that a lot more in detail. And our time's running on a bit here, so I want to make sure we continue to get through all this important stuff. So, as this Bitcoin continues to gain notoriety, we look at the different companies in the world that are starting to implement into their balance sheet. And so right now we kind of had that initial phase where you had like Paul Tudor Jones, famous hedge fund manager, start to buy it, start to be able to allocate it in his hedge fund because the prime dealer would allow him. And so we've had that come in. We've had a lot of kind of interest come into that. And so you had these corporations start to say, okay, we got big cash balances on our balance sheet. So MicroStrategy is run by a guy by the name of Michael Saylor. So it's a small little tech company in the US that had about a $1.5 billion market cap. 500 of that million of that was in cash. And so he looked around, he was looking for acquisitions, looking to continue to grow the business, looking at the kind of that rate of return of capital within the business. And what he landed on is he thought that the best allocation of his capital was into Bitcoin. So he ended up taking about $450 million and putting the cash reserves in Bitcoin. That's been an interesting thing to watch and follow. So Old Mass Mutual, one of the oldest insurance companies in the U.S., they took $100 million of their cash reserves and bought Bitcoin. Square, the smaller amount, but they took $50 million of reserves into Bitcoin. We've seen PayPal, and so PayPal is one of the biggest financial institutions in the world. And I think as we think about how this is going to play out and how people start to spend money, we've been on lockdown now, as everybody knows. The whole world's been on lockdown for the past 12 months. And so you've had a big adoption of remote digital banking. And I think you're seeing that happen quickly. And you're seeing financial institutions the world over look at it and say, wait a second, this is sped up kind of our plans that we thought might be 5 or 10 years down the road. And they're starting to say, we need to consolidate our branches. We need to consolidate what we're doing. So PayPal, obviously, they don't have any branches, any of that legacy stuff that they have to deal with. But what they've done in their system is if you have a PayPal account, you might have a Canadian dollar PayPal, US dollar, you could have a Bitcoin sleeve within there, which allows you to move within the different currencies. And so, that's kind of the early phases of the adoption. So, it's interesting to follow. I mean, Overstock as well. Overstock's a interesting company. They're the first online retailer to take cryptocurrency as payment. So whether you want to buy a lamp or a bed or whatever, they were taking it as payment. So on the back of this, they built some technology, some really interesting technologies. So they've spun out this technology called T0, and so T0 is essentially like a superhighway that allows companies to kind of list on their superhighway. So it's an interesting story and company to pay attention to. Galaxy Digital, which I talked about briefly on the weekly call last week. It's run by a guy named Mike Novogratz, one of the early investors in Bitcoin. They're doing similar things. They're thinking about how companies can have direct listings in finance, and kind of that old school investment banking is starting to kind of fall by the wayside. You're having SPACs start to come forward, which is a special opportunity vehicle. You've had kind of these digital forms coming in. So, I think that the financial industry is changing a lot and at very quick speed. And so it's made me really think about what that's going to do and what kind of an impact that's going to have. So I'm going to slip onto this. So 2020 in chart. So we had a massive dislocation in treasury bonds this year. Certainly in Canada and the United States, we entered a period for the first time ever in March where government bonds went no bid. So this is like Black Monday, 1987, where stocks went no bid. So there's nobody on the other side of this trade. So we had that happen in March. And so, you wanted to go ahead and sell your government bond, you're taking a 5% discount from what it's actually worth because there's no buyers. And so one of the knock-on effects of some of the rule changes after 2008, 2009, the banks don't make the market anymore. So the individuals that own these bonds are the hedge funds, the institutions, and these were the liquidity vehicles, and they didn't want to sell them. And they also didn't want to buy because they're trying to delever their position. So that's why we've had this central bank intervention like we've never seen. And so in Canada, what they went to was buying $5 billion of government bonds and mortgages weekly. They scaled that back a little bit, so they've tapered it back a little bit, but they're still in there buying that market, supporting it, and keeping yields where they are. So in the U.S., it's $120 billion a month. They're buying mortgages, they're buying government bonds, they're buying high yield bonds. They've intervened in all parts of the market. So this is a dislocation like we've never seen. And so jobs, again, I think it's important just to have a snapshot, just to think about it. I know the markets seem like everything's fine, but the underlying economy has changed dramatically. We saw the massive spike like we've never seen before. And so yes, jobs are coming back, and they're coming back in the US and Canada, but ultimately they're not going to come back to the same degree that they came back in January, February last year. So, likely in the US, you're still going to be short 2 or 3 million jobs. In Canada, it's going to be a smaller number than that, but percentage wise, probably going to be the same. So I think it's important to think about what that means, where it's going to have an impact on the economy. And so that's some of the things to think about from a rate perspective. Like I took a snapshot of this because this is what happened. They slashed rates and were pegged at zero in Canada and the US. I mean, in fact, right now you want to buy a 1 year Canadian treasury bond, you're going to get about a 10 basis point yield, like a 0.1%. So I know the central bank controls the short end of rates, and typically bonds trade around where the overnight rate is, at least on a 1 to 12 month basis. But now we're at 10. So the market's telling you that they think rates are low and potentially going lower. So it's important to pay attention to. So some of the vaccine, obviously, lots of great things rolling out. We're having some issues with that vaccine getting rolled out in Canada, even though we have more vaccines per capita than any country in the world. I'm hoping that we get some progress there. I know that they're trying to make some things happen and continue to work forwards and get that going. So I'm optimistic that's going to work out well for us. So this narrow market, some of you may have seen this before. Historically, as we get to kind of this narrowing market, you get less and less companies that are driving the returns of the index. And so what ends up happening is that boat gets heavily weighted to those bigger companies, and as a result of that, you get a little bit more risk. So you start to think about it. And so, do I want to own the S&P? If I still think there's growth to happen in the United States, maybe we got to cycle to some of the other names. And if you have that thesis, you can look for like an equal weight. So you can buy an equal weight ETF, which kind of levels out and maybe reduces some of that risk within portfolios. But we've got a super narrow return structure within the markets, and that historically hasn't been a good thing. So it's important to pay attention to it. So look, this is something that you follow and I followed over the years, is really that contrarian indicator, and thinking about as we get to these extreme levels of overbought or oversold, these are kind of the levels that we start to think about putting in some additional protection. So as we start to get down into that red zone, that's when we start thinking about putting some protection in place. putting some buying some puts or some kind of protection, long bonds, something that leads you to think about how we can add some protection there. So we're quickly approaching it, and it's something that I'm paying attention to. So the last slide before I start to talk about the macro and where we are right now from a macro perspective, because I think it's important and relevant right now, is just negative rates. So listen, oftentimes I'm talking to people about rates, and we kind of get that thinking about where we were 4 or 5 years ago, where we could buy a 5-year GIC at 5%. You got that stability and that safety built into portfolios, and now we've reached where we are today, where all the way across the curve in Switzerland is negative. All the way across the curve in Germany is negative, 0 to negative. You can go down the list here: Netherlands, Denmark, Austria, Finland. Kind of the whole European Union is negative rates, at least out to 10 years. And so if we looked at this, it's something to think about. Yeah, and something to think about. How do we adapt to that environment, and how do we make sure that we're also protecting the portfolios? And historically, you need that counterbalance. And when yields get down to so low right now, you have to think a little bit differently. And that's why I look at putting some alternative categories into portfolios, like the merger arb. It's similar to bonds like we've had in the past, give you that same kind of stable returns. You can't just buy the bonds and forget about them, but they still are an important integral part of portfolios. And so for those of you who've been following me, I talk about kind of the risk management. So I've been using Hedgeye for the last 3 years to provide a really a daily update on what's happening in the macro. And so the reason this is important, it's not like typical macro thinking, which is long philosophical debates about where we're going. It's what's the data saying on a daily basis. So they have something like 160 inputs that come in every day to give them a view of what's happening in the different countries around the world. So I picked the US GDP and CPI. The Canadian one looks almost identical as well. They've been a better predictor of what's happened in the US, but they work together and very closely correlated. So these different categories of where we are in the different cycles. And so this first one I put up here, if we look at that box where it says Q4 20 estimate. So this is basically where we are right now. And then if we look down along the bottom, you get kind of a predictability forecasting along the bottom there. So basically what they're saying, and which is accurate, is we're in a growing GDP mode, and we have inflation. And so you can debate inflation all day, whether you like it, don't like it. The numbers are the numbers. This is what they use. This is what the world uses, which is CPI, which I'll show you in the next slide, talking about CPI. And then they make a view based on what that's happening. And so this is what I've been taking. This is what's how the worlds have been playing out. And it makes you think about what's going to do well for the next little period of time. And so they've really helped augment that shorter term thinking. So what they have for Q1 and Q2 this year is more of that, which is their quad 2, which they call it, which is growth plus inflation. And so that's a narrative where you want to own some you want to own commodities. You want to own like some of the countries in Europe, Germany, Poland. Maybe you want to have some exposure to Australia, Brazil. So these are the kind of countries you want to have exposure to. Again, then you want to have a little bit of exposure to maybe consumer discretionary. So you look like the Under Armours, Capri. Look at some of these companies and names that are in portfolios today. So so that's the my view. So let me just take you back there. The key thing to point out and look at and pay attention to is their view for Q3 of this year. And so Q3, they're predicting, which is quad 4, which is a place most people don't want to go to, but it's the area and the time within the markets where we get slowing growth and slowing inflation, which is essentially recessionary numbers. So the thing and the reason that's important to pay attention to is they back these two kind of 2 and 4s against each other. And so we got a backdrop that I think the year's got to be split in half. I'm starting to think about what's going to happen the next 3 to 6 months, but also about what happens in the next 6-12 months, because I think that the back half of this year could be really rocky. What does well in a quad 4 environment, long bonds, US dollars, gold, typically do well in that environment. And so CPI, so I know I see him just starting to crest up here on roughly an hour or so, so I'll just touch on this a little bit. This is a major input for what happens into macro. So if we look at kind of the middle line that goes through there, we start with the pink box on the Q4 20 estimate. You got 126, you got 188, 308. And the important thing to look at from that next box, 308 to 268, well, you still have inflation, but you have a rate of change negative. So if you get a rate of change negative, the world and the market typically doesn't like that. It starts to anticipate that things aren't as good as they expected. And so when you get a negative rate of change, even if that number can easily be positive, it's bad for all things risk. So lots of things. Obviously, I always enjoy Lacey Hunt. I mean, so I appreciate who sent this along to me. But Lacey talks about debt and this debt spiral that the U.S. is in. So it's important to take a look at it. I mean, debt's certainly an issue. I mean, gross federal debt, U.S. private and public debt. I mean, these things are obviously off the charts, all-time highs. Velocity of money, which I talked about. So this is your M2 is very slow. I mean, as slow as it's been since the 1940s, mid 1940s. Again, this is things to think about, and it's going to have an impact on asset classes. On the positive side, oftentimes we don't see this. So, one of the things that the narrative been in Canada over the last couple of years is the real estate market can't go up anymore because debt's at an all-time high. I mean, that other input that oftentimes doesn't get looked at is what's the expense? What's the net expenses? Have they gone up as well? And so this is a look at Canada, the United States, or sorry, this is US, Japan, and G7. So that would take in all the G7 countries. And so you can look at the one slide on the left-hand side, talking about the general government gross debt. Obviously, it continues to grow at a higher level. But then we look at the other slide on the right-hand side. You look at Japanese, for example, the Japanese interest rate payments have gone down. So we've gone through this period where we've got explosion in debt, but you've had payments go down because interest rates have come down. So this is what central bankers are looking at. They're going, wait a second, we can continue to raise debt for a long time as long as we control the interest rate input. So for any people that start to think that rates can skyrocket, I'm not sure how we get there. Maybe they can move up a little bit, and they're playing with that number with tapering the bond buying, but I don't think rates are going higher anytime soon. So put out some charts like this, similar charts like this. Fed balance sheets, obviously the yellow one, and the Fed deficit is the gray one. So like these two typically have had a pretty close match, but we've had a big blowout here. So I mean, this I think is a major component to what's going to happen to rates and yield, and very, very important to pay attention to. Last couple of things I'll get into here is we'll talk a little bit of, I'll just give you kind of some of the highlights. At my core, I think about valuations, whether I like it or not. I got to think about it and pay attention to it. Even though flow has changed, market sentiment, many other things have had an input. At the root of it, I got to think about all things. Well, valuations don't apply immediately today. I do think they're going to have an impact on future values within certain things. So this is a snapshot. I think John Hussman put this out, and talking about just all these different metrics around valuations, medium EV to sales, you got US total market cap to GDP. I mean, all of these things are, 97 to 100% of where they've ever been historically. So, these are important things to think about and pay attention to. But we also have to think about what's happened in certain other areas and pockets within the world. Well, PE is trading, well, CAPE adjusted PE, that's your price versus earnings, trading around 30. If we look back at what happened in Japan in the 90s, it went from 30 to 60. So potentially still kind of a massive amount of expansion potentially in US markets. So we have to take a look at all these inputs, but this is the valuations one. They're all screaming red lights. This is another one. This is from Jesse Felder. This is the number of components that are trading 10 times sales. This is off the charts. I mean, I'm sure people know this intuitively, but if we look at it, you can show the scale from 1985 to today off the charts. All these companies in the red bar are trading greater than 10 times sales. So as I start to think about what's ahead and where those opportunities are as we look ahead, I start to look at some of these comparables. And so this is the U.S. over emerging markets for the last number of years. You're starting to get a tick up. You're starting to get a tick up in the emerging markets. And so I've followed a number of places where I think the opportunities are. As I've mentioned, I think India has good potential. I've taken a look at what's available from an investment perspective. I've looked at one specifically. There's a Sun Life New Leaders Fund. This is kind of the small mid cap India fund that I think has significant potential to outperform most other asset class over the 3 to 8 years. So this is something I think that'll be a component within portfolios at some point. So you start to identify these areas that have potential. Other spots within the emerging markets that could do quite well, which I'm probably not going to go into all of those areas, but I'd put Saudi Arabia in there. You'd put, Israel, I know is not an emerging market, but it certainly benefits from a lot of things that happen in emerging economies. And, from a valuations perspective, you have Iran trading at the cheapest valuations of any country in the world. Not that I'm going to invest in there, but you got to think about how the world's going to progress. Last few things we talk about what's happening as well. So this came out from BlackRock, and they're talking about really where the money's been flowing. And so there's been a tremendous amount of interest in ESG or green investing. You've had the big institutions and pension funds of the world kind of saying to the world too, if you don't do this, you're not getting our money. We've had Norway, which is one of the biggest sovereign wealth funds in the world, say, if you don't fall within this category, we're not investing in you. So you've seen them divest of a number of companies as a result of that. And so I think we're this is evolving, and I think going to continue to be a theme, especially as we see the political leaders really trying to take hold of this. So this is a little bit about the credit market, how it's evolved over the years. And so, I start to think about where these asset classes can fit in, especially at rates are at such a low level. I think that obviously that yellow bar is huge, which is global high yield. I think that's an area you actually don't want much exposure to, but some of the other places provide opportunities. Emerging market bonds, we have exposure to capital emerging markets. 50% of that portfolio is EM bonds. Private credit, this is interesting, but at a point where I think when it'll be appropriate. So this is a place that I pay attention to. Think about how do we generate some yield in a yield challenged environment without taking too much more risk. So as a lot of things happened this year, we've seen a huge speed up in that separation between the traditional department stores and really kind of a pull forward in Amazon and that online type of purchasing. And so, we've seen a huge divergence in there. I don't think it stops anytime soon. I think Amazon's probably stretched a bit far because they're not going to continue to grow at this pace. And I think there'll be more competitors that come along. But we've seen a big setup there. And this obviously this plays through to many different places, because the real estate businesses have had a challenge. I think about if I'm investing in REITs, do they have any exposure to commercial? What kind of exposure? Is it industrial? Is it just commercial? So these play a part when I'm thinking about what goes in the components. So from a decision-making perspective, a lot of you, I think, have a pretty good understanding from it on how I think about it. But I think about diversification of assets and risks. So those are kind of two different things. So it's not just here's 50% bonds and 50% stocks. I think about, well, what's my risk within these stocks? What's my risk within these bonds? And are they going to give me a return, or are they adding more risk? And so I think about those two components differently. If I am putting something into a portfolio, say I want to have U.S. bonds in the portfolio, then I take a look and see what my options are. Can I buy them directly? Can I buy an ETF? Can I buy a fund? What's the best place to put your money? And so some of the great news there is we've had a lot of new products come out, and we've had costs continue to come down. And this is a real great thing. And so there continues to be a lot of opportunities there. So these are some of the things I think about. And as for the tactical tilting, we've seen that, and you've seen that this year. We've done a lot more adjusting to what's happening in the shorter term cycle, where we'd keep a core component 50+% within longer term longer term holdings. We get about half the portfolio more tactical thinking about what's happening there when I'm adjusting the portfolios. So where do I think the opportunities are? So as I mentioned a little bit earlier, just kind of basing my views around what's happening, where the flows are coming, what the data is telling me is I think commodity short term can continue to do well. I talked a little bit about the Bitcoin. I didn't mention Ethereum. Ethereum's more of an infrastructure play in crypto. These are some of the names that we have a little bit of exposure to. Energy, tech, and consumer discretionary industrials, materials. So like the Caterpillars of the world, consumer discretionary. I mentioned some of the names before. Yeah, I think these are the components that do well now. Emerging market bonds, tips, inflation-linked things. Again, these are some of the things. I do think it's transitory, though. I don't think it's things that you can just pop into these and hold them off for the long future. These are things that I think do well for the first half of this year. And so when the world starts to transition into the back part, when we start to see the numbers roll over, that's when I start to think about some other components. And so in the back half of this year, some of these things that we owned kind of the back half of 19, I think start to play a positive part within portfolios again. So we start to see the US dollar gain some strength. We have some index puts, some long bonds, gold, and consumer staples. So I'll be looking at cycling those positions into to holdings that I think can do well with the environment that I see ahead short term. So I think we got to really pay attention to what happens 2021. We're coming off a really strange year. The data is going to be messy. We're probably going to get a Q2 data in the US at somewhere around 8% GDP growth, which is off the charts. But again, it's a year over year number. So considering how bad it was last year, we're going to get a lot of conflicting information that we have to take in. So, that's where I see the opportunities as we go. That's how my view and thesis, I believe, will play out this year. There's lots of things between now and then before we get there, but I'd say really that's my core thinking about where and how we're going. So for those of you who attended the Tom Dean's event in December, I really appreciate it. We've now sent out the book, so if you haven't got those, certainly let me know. But I think that was a great event. We've had some lots of follow-up questions around how we implement some of these things. Who do we talk to? We're planning to have a lawyer come on and speak, and I'm planning to interview her shortly. More details will be around that. That'll come out at some point. Hopefully that helps answer some of those questions. We're starting to think about taxes as well. It's a tax time of year, so we're going to have a tax expert on at some point as well. So, look, I appreciate everyone that's attended those things, and if you haven't seen the Tom Dean's event, let me know, and we can flip the link out to you. And so, as I mentioned at the outset, the key to successful investing is having everyone agree with you later. And so, I think about that continual view, what's on the horizon, how am I putting you in a position to succeed, how am I going to continue to think about what's ahead. And so, as a result of that, sometimes things I'll put in the portfolio might not look or make sense at any given time, but I'm constantly thinking about how do we position for what's ahead. And so the last piece is always, I'm trying to construct your portfolios that are built for growth but prepared for risk. And 2020 was a great example of that. And I think we had a nice, solid, stable year, good returns as a result of thinking that way. And I continue to do that and fine tune it on a continual basis. So I appreciate you all taking the time to listen to what I have to say today. I know it was a lot, and I actually spoke a little bit longer than anticipated, but I really appreciate the trust you continue to place in me. We'll look to continue to evolve our process, our communication, our systems, and that'll continue to get better as we move through this year. So, if there are any questions, certainly please pop them over to Scott or jump in, and I'll be happy to answer. Yep.
Yeah. You can hear me, Ben?
Yep, I can hear you.
We do have a bunch. I'm actually I'm gonna read them kind of in an order that makes sense on topic here. So the first one's from Ottawa News Network. Do you think that what's happened with Wall Street bets pumping the price of stocks like GME, AMC, etc., and the way that the brokerages responded make a stronger case for decentralized currency?
So that, I mean, that's a great question. I'm not sure they exactly relate to each other. I mean, I think that the intervention that happened was something that we continue to see anytime there's pressure put on the controlling entities in the world. So I think that what happened there, I think was something that they jumped ahead and made a decision that that's going to have a material impact. And I think there's going to be a lot of fallout from that. As for the decentralization, I think that's kind of a bit of a misconceived view where there's the part of the kind of crypto community that's ideally looking for a decentralized world where we don't have any control, we don't have any there's not one particular body that's making the regulation and the oversight. I think that's not the exact and proper way to think about how how this world evolves, because if you want the serious kind of that institutional money to give it the validity that I think it needs, is you need some regulation, you need some rules. You don't want to have what we have today, but you do need some rules and oversight for people to get comfortable with it, for you to be able to use it on an everyday basis when you go and buy stuff wherever you are in the world. You do want some regulation put in place. I hope that makes sense.
Great. Mukesh asks, I know that you put some safety, but buying puts against, or sorry, buying puts against indexes. Does it make sense to buy puts when some equities have a large gain, such as Bitcoin, to protect its gains?
So it's a great question, and it's something that I wish I could do, but the the construct of the world isn't there just yet. So we don't have the setup right now. So Bitcoin trades, as you know, for the individual, the only way you can buy it is through a closed-end fund version right now. And so there isn't any options against that. The only way you could potentially do that is buying futures. Obviously, that takes a significant amount of leverage to do something like that. It's not something that that I choose to go down. What's going to happen very shortly is there's going to be ETFs listed in Bitcoin in both Canada and the US. Once those ETFs come in place, then you're going to get the different options markets start to come in and start pricing options against it. And you get the banks start to come in and price options against it. And so at some point, yes, there's going to be some hedging capabilities. There's not a perfect hedge against it presently. So, if I'm looking to put hedging in, I'm typically looking for something where the volatility's been low. You get kind of a really high implied volatility. So, I'm trying to hedge something against the total portfolio, but Bitcoin doesn't have that capability right now. So the only way to do it is to trim and take some profits.
Okay, our good friend Lyle was wondering what sectors are the most overbought, overvalued, and hence most vulnerable to a bubble burst in 2021.
Well, certainly from a super short term perspective is, all these companies that have massive short interest right now. We've seen these big short squeezes, which I think put them at risk ultimately of being wiped out at some point. So I think they're not really sector specific, but those certainly have some risks. But I think there's a overarching thinking that technology is bubbly. I think there's pockets of it that really are. If you look on a valuations perspective, there's a lot of companies that trade at, like 10 times cash flow. I mean, a company trading at 10 times cash flow, that's not something, if in the private market, that's not something that most people are going to want to buy. So any of the companies that are trading at stretched levels like that would be at risk. I mean, the biggest place where the bankruptcies continue to be would be in, that commercial real estate, that kind of really levered old industry type of businesses. I know GE had some good earnings this week and their stock popped, but that's a company that I think has some serious challenges, as they got a massive debt load, and they got a challenging way to try to unwind that. So not a clean, simple answer, but I think it's really the leveraged companies, not necessarily a sector specific, because you get some of the good tech companies, they got huge cash on the balance sheet, and not a lot of debt. So even though their valuations are stretched, they can kind of ride through any of the potential downturns that could come.
Okay, another one from Lyle is, what are the leading indicators that you most track to identify trends in the market that enable you to seize opportunity or take precautions?
Yeah, so look, it's a great question. I know we've talked about this a little bit and a few times, and so I would say that one of the big and most influential indicators would be the U.S. dollar. And so the U.S. dollar is a massive indicator for all things risk, all things assets. So depending on the trajectory of that U.S. dollar, you tend to have it tend to gives you a signal for what's happening. And so right now we have, as I say, a massive short position, probably the biggest short position the U.S. dollar has ever seen. And that's a consensus view. And so what we saw just this last week, I think last weekend I mentioned it, is that we've seen that U.S. dollar start to perk up a little bit, and as it would sell down, it was starting to have some higher lows. And so this is a signal that I think you got to start paying attention to. The other input that I think has a material impact would be bonds. And so you'd look at something longer duration, but I tend to look at that 10-year as a pretty good indicator. So look at the U.S. or the Canadian 10-year when you're looking at North America, and you say, what's that signal telling me? Right now, I think you got that US 10-year that's kind of bumping up along some resistant levels right now. Again, if you see that peek through these resistant levels, well, it could be a signal that we actually have material inflation, where I don't think we're going to have that material inflation. I mean, central banks been talking about getting 2% inflation in the US for the last 13 years. They haven't hit it in 13 years, so I'm not sure how they're going to do it this time. But it's a signal to pay attention to. There's multiple other inputs, but I'd say those are two giant macro things that I pay attention to.
Great, that's it for the questions.
Fantastic. Good. Well, I appreciate you all spending the time listening to me, hearing what my views are and where we are. I appreciate continuing to work with you and support you and your families, and look forward to what 2021 has ahead. You need anything, let us know. Send us an email, book a meeting, book a call, and we'll look forward to speaking with you at that time. Thanks very much, and have a great evening.